If you want to ace your professional exams, you cannot afford to mix up the conceptual framework. In this lecture, we are breaking down the qualitative characteristics of financial statements. Now, to make sure this tough lesson sticks with absolute ease, I've introduced two brand new songs directly into the video. Grab your pens and let's dive straight into the teaching. What are qualitative characteristics? Qualitative characteristics are the attributes that make the information provided in the financial statements useful to a wide range of users. The attributes that make the information provided in the financial statements useful to a wide range of users. Users of financial statements. Users of financial statements. The users of financial statements include, number one, existing and potential investors. Existing and potential investors. Existing and potential investors. This set of people need financial statements to assess risk and return on their investments. They need financial statements to assess risk and return of their investments. Number two, we have lenders and other creditors. Lenders and other creditors. This set of people determine if their loan and interest will be paid on time. Number three, we have employees. Employees, they evaluate the stability and profitability of their employers. Employees need financial statement in order to evaluate the stability and profitability of their employers. Number four, we have customers. Customers need financial statement to assess if they should have a long-term reliance on the company for goods or services. They need financial statement in order to assess if they should have a long-term reliance on the company for goods or services. Number five, we have government and their agencies. Five, governments and their agencies. Government and their agencies. They regulate activities, determine taxation policies, and require national statistics. Government regulate activities, determine taxation policies, and require national statistics. Number six, we have the general public. Six, the general public. The general public. General public monitor local economic trends and corporate social responsibilities. They monitor local economic trends and corporate social responsibilities. Qualitative characteristics act as the strict quality control standards that ensure financial reporting serves all these groups effectively. International Accounting Standard Board, IASB, Conceptual Framework, classified the qualitative characteristics into two. The qualitative characteristics of financial statement can be categorized into two. We have fundamental qualitative characteristics and enhancing or enhance. You can say enhance or you put enhancing. Enhancing qualitative. Enhancing qualitative characteristics. Qualitative characteristics of financial statements, I've told you they can be categorized into two. We have the fundamental qualitative characteristics and we have the enhancing qualitative characteristics. So I'm starting with the fundamental qualitative characteristics. Fundamental qualitative characteristics are the attributes that determine whether financial information is useful or not. Fundamental qualitative characteristics are the attributes that determine whether financial information is useful or not. I repeat, they determine whether the financial information are useful or not. If information lacks these characteristics, it cannot be included in the financial statements. I mean, if information does not contain or does not have the attributes of a fundamental qualitative characteristics, information that doesn't have the quality of fundamental qualitative characteristics, those information cannot be recognized in the financial statement. They cannot be recorded in the financial statements. Fundamental qualitative characteristics of financial statements can be divided into two. We have 1, relevance, 2, faithful representation. So we are starting with relevance. Relevance. Financial information is relevant if it is capable of making a difference in the decisions made by users. It is relevant if it is capable of making a difference in the decisions made by users. Information is relevant if it can be used for predictive or confirmatory purposes. If it can be used for predictive or confirmatory purposes. From the definition, you can deduce 3 attributes of relevance. Number 1, we have predictive value. Number 2, we have confirmatory value. And the third attribute is material or materiality. So, predictive value. This means the information helps users predict or forecast future outcomes. By predictive value, it means user can make use of the information in forecasting future outcomes. Number 2, we have confirmatory value. This means the information helps users confirm or change past evaluations and expectations. The information helps users to confirm or change past evaluations and expectations. And the third one is material, that is materiality. This means omission or misstatements could skew a user's decisions. The omission or misstatement of such information could skew, could distort, could affect the user's decision. Then number 2, qualitative characteristics. No, we are looking at qualitative characteristics of financial statement. And we've talked about relevance. And the second one is faithful representation. Faithful representation. So, faithful representation. To be useful, financial information must faithfully represent the economic substance of the transactions, not just their legal form. For a financial information to be useful or to be faithfully represented, it must represent the economic substance of the transactions and not their legal form. For a financial statement to be faithfully represented, it must have the following three attributes. Number one, we have complete. The attributes or qualities of faithful representation, we have complete. By complete, it means it must include all necessary data. Complete information must show all necessary data. No important information must be left out. And then number two, we have neutral. Neutral. So it means it must be completely unbiased presentation. It must be completely, totally everything. Unbiased presentation. And the number three is free from error. Free from errors. That is accurate calculations and process application. Let's look at the pillar one sum to master the fundamental qualitative characteristics of financial statements.
Oh yeah, Ezikan. My people, make una listen now. For your financial statement, fundamentals are the key. Two big pillars standing tall for all the world to see. Number one is relevance with predictive and confirming might, and faithful representation. Everything must be right. That one must be complete, neutral, and from error free. Ezikan's way. You are good to go for your exam, you see.
The second pillar of qualitative characteristics of financial statements is enhancing qualitative characteristics. That is the second pillar. Enhancing qualitative characteristics. Enhancing qualitative characteristics are characteristics that improve the usefulness of information. By enhance means to improve it, to make it better than it was before. So those characteristics that improve the usefulness of the information, we refer to them as enhancing qualitative characteristics. They maximize the value of true data for users. These characteristics, this information, maximize the value of true data for users. To master the enhanced qualitative characteristics, take note of the mnemonic cut V. Mnemonic cut V. So the first letter C stands for comparability. Comparability. This is the quality that enables users to identify and understand similarities among items. These features, these qualities enables or allows users to identify and understand similarity among items. For information to be comparable across different financial years or different companies, you must maintain consistency in applying your accounting policies. Your accounting policy must be applied consistently for the information to be comparable between one period and the other. So that is comparability. The second letter U is understandability. U, understandability. Understandability. So financial information must be classified, characterized, and presented clearly and consistently so that users can comprehend it. User will be able to understand it. You must classify financial information. You must classify them in order so that users will be able to understand it. That is for letter U. Letter T is for timeliness. T for timeliness. Timeliness. This means having information available to decision maker in time. The information needed or required by the decision maker must be available on time. They must be available timely. That is timeliness. The last letter V is verifiability. V for verifiability. Verifiability helps assure users that the information represents what it claims to. That is, the information should be what they claim to be, so not in the opposite. So what the information claims to represent, it must be so. That is verifiability. So we want to consider Pillar 2 song.
Let me teach you something new for your professional life. Ezikan brings you CUTV to make your numbers right. C is comparability, compare across the years. U is understandability, make it simple and clear. T is for timeliness, don't delay the reports. V is verifiability, check the numbers from different sources. CUTV, enhancing the quality, Ezikan said so.
Pillar 2 is the enhancing qualitative characteristics. He said this improves the usefulness of information using COT V. In the course of this lecture, we classified qualitative characteristics into 2 pillars. Pillar 1, fundamental qualitative characteristics. And we said that is divided into 2, the relevance and faithful representation. We said relevance have predictive and confirmatory value. If this musical approach and simplified breakdown cleared up your confusion, smash that subscribe button right now. Drop a comment, COT V, and share this video with your Facebook and WhatsApp groups. Keep winning, and I will see you in the next lecture.